Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at BigBear.ai.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. If there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. This is a really complex story, It's about a company trying to make this massive pivot.
Right, from a traditional government services contractor?
Exactly. Into a scalable, platform-driven AI provider. And, the latest reports, they really give us a perfect snapshot of the risk here and the potential reward.
Okay, so let's start with that snapshot, the Q3 2025 numbers. The market reaction was surprisingly positive, right? But the actual numbers, they tell a much more tense story.
They do. Yeah, revenue was down.
So why was the market cheering?
Well, it's all about expectations. In short, they shrank less than everyone feared they would. Operationally, Q3 revenue landed at $33.1 million.
Which is a big drop, about 20% from a year ago?
A very noticeable drop, yeah. But the key is why. It wasn't a failure of their tech. It was, the classic defense contracting world. Lower activity, delays on some big U.S. Army programs.
So it highlights that vulnerability to the government spending cycle.
Perfectly. But that $33.1 million still managed to beat the consensus expectation, just by a little bit. And in this environment, that small beat, it gave the market the relief it was looking for.
So shrinking revenue, which is bad, but it beat expectations, which is good.
Okay.
But what about the actual health of the business, the profitability, the margins?
Yeah, that's where you see the stress. The operational core is still under a lot of pressure. Gross margin contracted a bit, down to 22.4%.
Down from almost 26% a year ago.
Right. And crucially, adjusted EBITDA was negative, a loss of $9.4 million for the quarter, which confirms the business is still very much in turnaround mode. It's burning cash.
But then you see this headline number. The GAAP net income was positive, $2.5 million.
Yeah.
If you just glance at that, you'd think they'd turned a corner. Why is that number so misleading?
It's incredibly misleading because that profit, it wasn't from selling software or services. It was almost entirely driven by a huge non-cash gain from derivative valuation changes.
So accounting adjustments.
Exactly. Think of it as paper profit from the value of their debt instruments. It had nothing to do with core operations. If you strip that away, the picture is still deep in the red.
So the stock rallied not because the business is thriving now, but because of that small beat and, I guess, the promise of what's coming next.
The promise of a massive strategic move, yes.
And that move is the acquisition of Ask Sage. It seems like the company is using its financial muscle to go on the offensive.
That's the goal. They want to stop being a services company that just uses a bit of AI and become a true platform company with, scalable, secure software.
And Ask Sage is the key to that, the catalyst.
The biggest catalyst this quarter. They have a definitive agreement to acquire it for $250 million.
That's a hefty price tag, isn't it? $250 million for a company with $25 million in annual recurring revenue? That's a 10x multiple.
It's a high price, no doubt. But you have to look at the growth. Ask Sage's ARR is on track to hit that $25 million this year, which is a six-fold increase from 2024.
A 6x increase, okay.
So the market is paying a premium for that insane acceleration.
But why Ask Sage specifically? What makes this platform so special for a defense contractor?
Security. It solves the single biggest problem the government has with modern AI. How do you use it securely? Ask Sage holds the crucial FedRAMP High accreditation.
For anyone who doesn't know, FedRAMP High is basically the golden key to the most sensitive classified government networks.
It's a massive security barrier, a multi-year, multi-million-dollar process that you just can't replicate overnight. So it immediately positions them as the secure middle layer between, say, a Google or OpenAI model and the classified systems that need to use them.
An air-gapped, trusted solution.
Exactly. It's model agnostic, too. So the customer uses the best AI, and BigBear.ai provides that secure wrapper around it.
And this isn't some pilot program, right? This is already deployed.
Fully deployed. And that's another reason for the high price. It's a turnkey platform already in production. It supports over 100,000 users across 16,000 government teams.
Wow. U.S. Space Force, the Army?
Mm-hmm. So this isn't just buying technology, it's instantly capturing a massive, sticky, secure distribution channel.
Which brings us to the next piece of this puzzle, the balance sheet. You need serious capital to make a $250 million move like this.
And this is where the story gets really interesting. They ended Q3 with a record cash and investments balance of around $715 million.
$715 million.
And when you net that against their debt and liabilities, they have a net positive cash position of almost $575 million.
For a small cap tech company that's still losing money on operations,
Mhm.
that's not just a strong balance sheet. It's a financial fortress.
It is. Now, that liquidity, it didn't just appear out of nowhere. We have to be clear, this cash was partly raised through at-the-market equity offerings.
So some shareholder dilution was involved.
The classic trade-off, dilution for liquidity. But that cash buffer, that $575 million net, it gives them this critical runway. It de-risks the whole turnaround story.
It lets them execute the acquisition and ride out any government contract volatility without worrying about solvency.
Precisely. And that's what analysts are looking at. They're already narrowing projected losses and modeling a substantial revenue rebound in 2026, maybe around 30%,
Well,
all based on integrating Ask Sage.
okay, but here's the contradiction. A fortress balance sheet usually implies stability, confidence. Yet this stock is incredibly volatile.
Yeah, the beta is very high. It's a roller coaster. Up 17% one week, sharp drops the next.
So why are these two things fighting each other? The stable balance sheet and the volatile stock price.
Well, that fight is where things get tactical. There's a specific viewpoint that the price drop after all this good news wasn't just profit-taking.
Okay.
The theory is that it was an aggressive, deliberate, short attack run by institutions.
A liquidity trap. Let's unpack how that playbook is supposed to work.
Okay, so the playbook starts with using the good news as bait. The acquisition, the earnings beat, that attracts a lot of buying from retail traders, pushes the price up to a peak.
Around $6 in this case.
Yeah, 6 to 6.15. Then, once that momentum is there, institutions allegedly engage in shorting into strength. They just unload massive coordinated short positions to overwhelm the buying.
And this is where the dark pools come in, right? As the mechanism to hide what they're doing.
Exactly. Over a third of the entire day's trading volume was routed to dark pools. These are private exchanges, so they can offload huge blocks of shares without showing their hand on the public market. It suppresses the price without causing an instant crash.
So they hide the selling, trap the price, and then what's the objective?
The objective, according to this analysis, was to break the critical $5.50 support level. That's the start of what they call the stop-loss hunt.
Because that's where retail traders set their automated sell orders to limit their risk.
Right. Break that level, and you trigger a cascade of automated selling from people who are now forced to sell low. The institutions that started the short attack can then cover their positions at a huge discount. They basically harvest the liquidity.
But at the same time, you see what some people call smart money moving in. Jump Financial, a big institutional buyer, picked up 5.5 million shares.
And that's the battle, isn't it?
Yeah.
Short-term tactical games versus long-term strategic accumulation. Institutions like Jump are clearly looking past the daily noise and focusing on that net cash and the Ask Sage acquisition. They see the value.
And before we wrap up, we should touch on their global reach and the big structural risks that even that cash can't completely solve.
Good point. The global expansion is real. They signed an MOU in Malaysia for an AI-driven aerospace hub. They're opening an office in the UAE for regional security.
And even here at home, their Veriskin biometric platform keeps expanding at major airports. O'Hare, Seattle, Nashville.
It just reinforces their core strength in mission-critical systems. But the big risk remains.
The customer concentration.
That's the one. The Q3 drop proved it. 4 major clients make up 52% of total revenue. Any delay or budget change from a single government agency has a huge immediate impact.
And they're still tiny compared to their peers. I mean, one major rival reported over $1 billion in revenue with 63% growth.
It's a massive gap. The whole investment case here rests on future growth and that successful pivot to software, not on their current size.
So to sum it up,
The investment thesis really relies on that 2026 revenue rebound and the successful integration of Ask Sage. Now, near-term operations are still a challenge with the negative adjusted EBITDA, but that huge net cash cushion. It provides a rare level of protection in the volatile small-cap AI space. It positions them for a high-risk, high-reward future.
if you want to keep up with these crucial technical shifts and strategic acquisitions, make sure you subscribe, like, and comment below. We'll see you next time on Smart Wealth with Joshua.